Today I want to talk about borrowing to invest and prepaying your interest prior to the end of financial year. Hi, it's Rafi from Manly Financial Services, coming to you from not so sunny and quite cold Manly. In today's video on our tax series, I want to be talking specifically about borrowing to invest in growth assets with a focus on the tax strategy of prepaying your interest this financial year in order to claim a deduction on that interest. I'm not going to be talking about all the intricacies that are involved in borrowing to invest in growth assets because there are a number of them, and you definitely need to get some advice in relation to this if this is a strategy that you're interested in. So how do we borrow to invest in growth assets? Well, we've got to find a funding source, and in many cases the funding source could be a home loan. The funding source could also be a margin loan or any other type of investment loan. The key with these loans is to ensure that it's designed or it can be utilised to invest in growth assets such as shares. In regards to tax, however, the key here is the intended purpose of the borrowed funds and not where the funds are coming from. For instance, if I was to borrow funds from my home loan, even though it's coming from a non-tax deductible source, being a loan on my home, as long as I'm investing those funds across shares, across an investment that is meant to be producing income, I can claim a deduction on the interest for that portion of the loan that I choose to invest. Some of the keys for borrowing money and investing in shares are ensuring that you've got a longer term time frame, the portfolio is diversified and meets your risk profile in terms of the types of stocks that you want in that particular portfolio, and to ensure that you've got enough cash flows, sufficient cash flows in order to meet interest costs on an ongoing basis. So from a tax perspective, the strategy here is that we can prepay the annual amount of that interest in the first year prior to the end of financial year. So if I had a $100,000 loan, for argument's sake, on a 3% interest rate, the interest would be $3,000. I can prepay that interest and claim a tax deduction of $3,000 in that year. That tax deduction will reduce my taxable income and give me a tax saving. It's important to note, however, that the income and capital gains that will be derived from that portfolio will be taxed in the year that they're generated. Now, this strategy, borrowing to invest in shares, is definitely not for those people who have more conservative risk profiles. So it's very important to sit down with a financial planner, look at your risk profile, your risk tolerance, and ensure if this type of strategy is ideal for you. This video is only intended for general information and general purposes, definitely no advice here. You do need to sit with an advisor and get some personal specific advice. Hope this video was of interest and gave you some useful information prior to the end of financial year. Please like, subscribe and click the notifications bell. If you'd like more information about this strategy or any other financial planning matter, please visit our website at manlyfs.com.au and contact us so that we can connect you with one of our experienced advisors.